and welcome to our special Q&A following our webinar on income tax accounting, ASC 740, considerations for 2024 financial reporting year. We received a number of questions from attendees during the broadcast, and the team has reassembled to address some of those, and we're going to dive right into your questions now.
Thank you, Matthew. We received a lot of great questions following that webinar, and we're going to take a few minutes today to answer some of those. If you are in a full valuation allowance, do federal and state level differences really matter? The short answer is yes. Regardless of any of the new disclosure requirements, entities are required to disclose at a minimum their gross deferred tax assets, gross deferred tax liabilities, and valuation allowance. If you're not measuring your state deferreds correctly, those net balances are going to be misstated.
It's just to piggyback off that a little bit, Noreen, from the auditor's perspective, sometimes what we see in practice is what happens when you come off the full VA. You really need to have what that inventory is. And I'm going to switch to some questions that came through on the tax credits, and I'm going to cover 3 questions kind of in one failed swoop. So one of the questions was asking about the journal entries, kind of the debits and credits. One was asking about the impact on the effective tax rate. So I think walking through the journal entries will kind of help people understand kind of the impact to the effective tax rate. And there was one question about what the notional value, when I mentioned that, was. And the notional value is basically the face value of those credits. So let's just go through a simple example. You bought credits, you got $10 million, let's say you got in tax credit, and you paid $8 million for that. Well, you'll record a deferred tax asset for the $10 million. You're going to credit cash for 8. And now you've got this deferred credit that I mentioned, which would be a liability for $2 million. That would be your entry when you purchase those credits. Now, when you use those credits, and as they get used, as I mentioned, that deferred credit balance would go down in proportion to that. So if you think about it, then your day 2 entries as you use that would be you'd be reducing your deferred tax asset down through your income tax expense provision, through your deferred provision, but then that deferred credit would then be reduced. You'd be debiting that balance on your liability, and you'd be crediting your current income taxes. So that would kind of then your effective tax rate would get impacted as that comes down in proportion to the deferred tax asset being utilized. So hopefully that kind of answers those questions in broad stroking. Basic example.
All right, we're going to switch to the updates under 2023-09. First question, for the rate reconciliation, should you push the state effect of permanent items to the individual permanent items instead of including them in the state income tax line? The answer to that question would be no. Under the new ASU 2023-09, the expectation is that everything related to your state and local jurisdictions, including the effect of permanent items, would be in the category for state and local income taxes net of federal benefit. The only exception to that would be unrecognized tax benefits. The ASU does provide that unrecognized tax benefits or changes in unrecognized tax benefits, regardless of whether it's your federal jurisdiction, your state and local jurisdictions, or foreign, would all be included in that changes in unrecognized tax benefit category. Another question that came in was, how does this impact nonprofit entities where only a small portion of our income is actually taxable? Which also ties into an additional question. We are a private company, and it appears that the impact of adoption will not be significant for us. Is early adoption permitted? I think I would start answering this question with this ASU 2023-09 and the changes to the income tax disclosures is applicable to all entities, whether or not you're a public entity, a non-public entity, a taxable entity, a non-taxable entity. If these are insignificant or immaterial to you, you might consider early adopting. That is permitted under the ASU. And you might say, I just want to get this out of the way. It's not going to be hard. I'm going to start with my 2024 financial reporting year. It also I think ties into this point about materiality. The FASB didn't specifically set any materiality thresholds within this ASU, but they did note that within the codification, it is stated that regardless of whether something exceeds the quantitative threshold, it may still be immaterial. And I think that plays into companies may need to use their judgment. You might also see this come into play if you're a company that has effectively break-even pre-tax book income loss, where literally every item in your provision that is a rate driver exceeds 5% and would be required to be disclosed if you're applying that 5% threshold as the way it was written. So I think you'll see judgment and materiality.
Yeah, and Noreen, I think the one thing I would add on that too is, people need to be cognizant too, just because maybe they come to the conclusion it's not material one year, perhaps the next year it could be material. So that's an assessment that needs to be continuously done, right? Not just at the onset when you adopt and say, okay, here I looked at this and now it's not material, it's insignificant. But every year you need to go through that and determine, hey, is it still not material, insignificant, or perhaps it is becoming material to where you will be including that.
Great point, Julie. I think that's also probably a good segue into questions about timeline, right? I mentioned during the webinar that this is 2 to 3 years out before it's required to be adopted. And I talked a bit about some considerations for what might go into adoption or implementation. And a tag-along question that comes along with that is timeline. I think the short answer is it's not one size fits all. A small company with a very simple structure, state footprint, form footprint, it might be easy breezy. It's just going to take, days. Other large multinational companies, it could take weeks or even months, especially if you're using a software solution that you need to configure to help enable this reporting. That's going to have some lead time to it. Another question was with regards to cash taxes. Does it relate to the current year or does it include historical payments for audits or IRS assessments? So the new disclosure under ASU 2023-09 for cash taxes paid, net of refunds received, that is cash taxes paid or refunds received in the current period. So if you cut a check to the IRS to settle an audit difference, that would be included in your cash taxes paid that you're reporting in the current period. What does the term absolute value mean? During the webinar, I believe I used absolute value in reference to the cash taxes paid disclosure when determining when a jurisdiction exceeds the 5% threshold. Absolute value would be the positive number. So if you have a jurisdiction that had a net refund received, that would technically be a benefit, which would probably be a negative in your work papers. You'd want to take that as a positive as your numerator over your net income taxes paid or received. Another question was, if we had tax due, but it was all offset by net operating losses or tax credits, do we need to disclose the amounts pre-net operating loss tax credit offset? I think the short answer here is no. Again, your cash taxes paid or refunds received, that would be cash taxes, right? If you had a tax liability, but you offset it with a net operating loss, you didn't have any cash taxes due to the tax authority. For the changes in tax laws, is the date of enactment the same as the effective date? Not necessarily. We often see tax legislation that is enacted in one period, but the effective date is in a subsequent period. So those could be two different dates.
Well, thanks again to everyone who attended today's session. We really appreciate all the questions that came in. They were great. We realized the audience was fully engaged, which means a lot to us. Thanks again to my co-presenter, Noreen. I think if there's any questions or any follow-up anybody has, please feel free to reach out to either one of us. And we hope everyone has a great day and hope to see you again on a future webinar. Thank you.